Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover Chapter 4, Additional Income and the Qualified Business Income Deduction from Income Tax Fundamentals 2024. By the end of this chapter, you should be able to define the term capital asset, apply the holding period for long-term and short-term capital gains and losses, calculate the gain or loss on the disposition of an asset, compute the tax on capital gains, describe the treatment of capital losses, apply the exclusion of gain from personal residence sales, apply the tax rules for rental property and vacation homes, explain the treatment of passive income and losses, describe the basic tax treatment of deductions for net operating losses, calculate and report the self-employment tax, both Social Security and Medicare portions for self-employed taxpayers, and compute the qualified business income QBI deduction. So as it relates to Chapter 4, just a quick overview. Chapter 4, as we just saw, covers additional important elements of income and expense, which enter into the calculation of adjusted gross income, AGI. So we start off with capital assets. So what is a capital asset? When a taxpayer disposes of property, they ultimately need to calculate a gain or loss on a transaction, and they'll report the gain or loss on their tax return. The tax law defines a capital asset as any property, whether used in trade or business or not, other than stock in trade, inventory, or property that's held primarily for sale to customers in the ordinary course of trade or business, depreciable property or real property used in trade or business. These are considered Section 1231 assets. A patent, invention, model, or design, whether or not patented, a secret formula or process, a copyright, a literary, musical, or artistic composition, a letter of memorandum, or similar property if the property is created by a taxpayer, accounts or notes receivable, certain U.S. government publications, and in general, virtual currency is treated as property. So again, as it relates to capital assets, it's very important to realize that when the taxpayer disposes of the property, when they sell it, they ultimately need to determine, was there a gain or was there a loss? The gain or the loss that's realized is equal to the difference between the amount realized on the sale or exchange of the property and the taxpayer's adjusted basis in the property. And how the gain or loss is going to be reported, it's dependent on the nature of the property and the length of time that the property has been owned. And gains and losses on the sale of capital assets, they're known as capital gains and losses, and they're classified as either short-term or long-term. So we move on to holding period. Ultimately, this has a great impact on the taxation of the sale. So determining the holding period is the first step in determining the tax treatment for an asset. So assets must be held for more than 1 year for the gain or loss to be considered long-term, and a capital asset sold before it's owned for the required holding period results in a short-term capital gain or loss. When there's a net short-term capital gain, it's treated as ordinary income for tax purposes. And one key thing to keep in mind is that when calculating the holding period, the taxpayer has to exclude the date of acquisition, and they include the date of disposition. So again, simply stated, much like in accounting, short-term is 1 year or less, long-term is more than 1 year. So capital gains and losses, they receive special tax treatment, and the tax treatment is based on the length of time that the property has been owned. So it's very important to keep that in mind. So next, in order to calculate the gain or loss, as mentioned earlier, we start off with the taxpayer's gain or loss. by calculating it as follows. The amount realized minus the adjusted basis equals the gain or loss that is going to be realized. So the first thing, the realization of a gain or loss requires the sale or exchange of an asset. So the term sale or exchange, it's not defined in the tax law, but a sale generally requires the receipt of money or the relief of liabilities in exchange for property. So an exchange is the transfer of ownership of one property for another property. So I sell my building, you give me cash. I sell my equipment, you give me cash. Next, we have to factor in the amount realized. So the amount realized from a sale or other disposition of property, it's equal to the sum of money that was received, plus the fair market value of any other property received, less the costs paid to transfer the property. So if the taxpayer is relieved of a liability, the amount of the liability is added to the amount realized. Since we see here, the amount realized equals cash, plus the fair market value of property received, plus the liabilities assumed, minus the selling cost. So this is the first step, the first part of the calculation. From there, we move on to the adjusted basis. The adjusted basis of property is equal to the original basis, which is basically the price that you paid at its inception. So it's usually its cost plus any costs incidental to the purchase. This includes settlement fees, closing costs. And from there, we add any capital improvements. And capital improvements, these are any expenditures that significantly result in an increase to the property's value or lengthen its useful life. So let's say we are considering a home. For an example of property, let's say we paid $100,000 for the home and we had a roof, not just a repair, but we replaced the entire roof, and let's say it cost $20,000. That $20,000 spent to replace the roof would be added to the basis because that's a capital improvement. It increases the value of the home. It is going to lengthen the useful life of a home. Once roofs are completed in this day and age, they normally give you like a 30-year guarantee. So in such case, a roof would be an example of capital expenditure versus, let's say, a homeowner paints a room. I mean, it betters the home, but it doesn't necessarily significantly increase the property value. So therefore, painting of a room would be treated as an expense. It would be written off in the current year versus a capital improvement, which would be depreciated, capitalized over a number of years. So it's very important to distinguish between an expense versus a capital improvement to a property. Next from there, we just account for some additions or some things that would essentially have an impact on the basis of a property. So any charges for installing utility services, any legal fees, any recording fees, survey fees, transfer taxes, any owner's title insurance, and any amounts that the seller owes that the purchaser agrees to pay. So these would be included in the basis. Next, we have some amounts, some settlement fees and closing costs that cannot be included in the basis of property. This includes amounts paid in escrow for the future payment of items, taxes, insurances, etc., any casualty insurance premiums, any rent for occupancy of the property before closing, any charges for utilities or other services related to occupancy of the property before closing, any charges connected with getting the loan, for example, points, loan assumption fees, cost of a credit report. Unfortunately, these are not considered deductible. The basis of property, it ultimately depends on how the property was acquired. So this is something very important to keep in mind. Was it purchased outright? Did you just decide to buy it? Or was it an inheritance? If it was an inheritance, then the original basis is generally equal to the fair market value at the time of the decedent's death. And if it's acquired as a gift, the amount of the basis depends on whether the property is sold for a gain or a loss by the donee. So again, these are some things to keep in mind. One thing to keep in mind that if it's acquired as a gift, again, the general rule is that the donee's basis is the donor's basis at the time of the gift. In this way, the donee, they basically step into the shoes of the donor and the built-in gain is preserved. But if the property's fair market value is less than the donor's basis at the time of the gift, this is depreciated property, right? Let's say you paid $100,000 for a property and now the fair market value is $80,000. That is considered depreciated property. The value of it has decreased. So in such case, when it was a gift, the basis at the time of sale, it depends on the selling price. If it's sold for less than the fair market value at the time of the gift, then the basis is the fair market value at the time of the gift. There's a loss basis. If it's sold for more than the donee's basis at the time of the gift, then the basis is the donee's basis, which is a gain basis. And if it's sold for a price that's between the gain basis and the loan basis, the loss basis, the basis is deemed to be equal to the selling price, and therefore there's no gain or loss realized. So obviously, there's a lot of nuance as it relates to property being acquired as a gift, but just note that the basis for gain and the basis for loss is different only when the gifted property has a fair market value on the date of the gift that's less than the donor's adjusted basis of the property. And then in such case, to that extent, the donor sold the property, it's going to result in a deductible loss. And in such case, the donor will probably be better off selling the property and then transfer the proceeds to the donee. So great tax planning opportunity. So here we have an example. It says, calculate Juliana's amount realized and recognized gain. So example, on August 4th, 2023, Juliana sold 326 shares of stock in Nanoplasma LLC that she had purchased on June 18th, 2005. Her cost basis is $10,000. She sold the shares for $19,000 and paid a commissions of $1,300. Calculate the realized and recognized gain. So in such case, the amount realized is $19,000. And again, to calculate the realized gain, it is based on the proceeds received, and in this case, it was $19,000 minus any costs essentially associated with transferring the property. So the $19,000 minus the commission of $1,300 gives us an amount realized of $17,700. The realized gain in such case is the $17,700 minus the basis of $10,000. So therefore, there's a realized gain of $7,700. So this is just a quick example on a very small scale, but ultimately, that is how we determine how these amounts are going to be treated. Next, we move on to net capital gains. So in recent years, the tax rates on long-term and short-term capital gains, they've become fairly complex for the most part. So short-term capital gains, straightforward, they're taxed as ordinary income. However, there's various preferential long-term capital gains tax rates depending on the type of gain. So as we see in this chart, short-term capital gains taxed at ordinary income rates. It's consistent with the individual's filing status. Are they single, married filing joint, married filing separate, head of household, qualifying widower, or qualifying spouse? Next, typically for long-term capital gains, they're taxed at either 0%, 15%, or 20%, and it ultimately depends on the level of taxable income. Next, we have long-term unrecaptured Section 1250 gain. This is taxed, it's capped at 25%. And this ultimately deals with business property. Next, we have long-term collectible gains. This would be art, gems, coins, stamps, etc. These are capped at 28%. And then just keep in mind here at the bottom, it talks about the 3.8% Medicare tax on net investment income. And this includes qualifying dividends, and this essentially applies to high income taxpayers that have income over certain levels. In such case, they ultimately are subjected to an additional tax for long-term or well, I would say portfolio income, because this includes dividends and other investment income. So as it relates to ordering rules for capital gains, so since there's multiple kinds of capital gains on which to calculate tax, there's an ordering system that's necessary to know which capital gains to tax and at which rates. So the various kinds of gains that's included in taxable income is in the following order. We start off with short-term capital gains. From there, we move on to unrecaptured Section 1250 gains on real estate, gains on collectibles, and then lastly, long-term capital gains. So if taxpayers are tax practitioners, they have several different types of capital gains that, take place in a tax year. Obviously, the calculation can become a bit complex. So it's very important, to have good tax software, because certain tax softwares, they kind of help to remove the complexity of such situations, because based on the property as its input, the program would automatically determine the ordering rules for the capital gains. So here we have the calculation of the net capital position. So if a taxpayer has a net long-term capital gain, this is essentially when the long-term capital gains is in excess of the short-term capital loss. In such case, the gain is going to be subjected to a preferential tax rate as discussed above, 0, 15, or 20%. And thus, a taxpayer has to net all of the long-term and short-term capital transactions that take place during a year, so that way they can calculate the tax liability. So next, step 2, they're going to determine if there's a net capital gain or loss. So when the net long-term capital gain is offset by the net short-term capital loss, then if there's a net long-term capital gain, that is essentially, again, when the net long-term capital gain exceeds the net short-term capital loss, or if there's a net short-term capital loss, and this is when the net short-term capital losses exceed the net long-term capital gains. Next, is there a net long-term capital loss that's offset by the short-term capital gain? So you can ultimately have a net long-term capital loss, and this is when the net long-term capital loss exceeds the net short-term capital gains, or it can be ordinary income. And this is ultimately when the short-term capital gain exceeds the net long-term capital loss. And again, when you have the tax software generally does this, but it's important to understand the nuance behind it. Why? Because that presents tax planning opportunities. So here we have this example. It says Chevril has the following capital gains and losses in the current year. There's short-term capital loss of $2,000. There's a long-term capital gain of $12,000 and a long-term capital loss carryover of $7,000. And as we see here with the asterisk, it was carried forward from the prior year. So it's asking, what is Chevril's net capital position in 2023? What are the tax implications for Chevril's capital activities if he has adjusted gross income, AGI, of $42,445, and his filing status is head of household? So the first thing we need to do, step 1, again, we need to determine what is the total amount of short-term and long-term. And is it a short-term capital gain? Is it a short-term capital loss? And is it a long-term capital gain, or is it a long-term capital loss? So in this case, we have a net short-term capital loss based on the fact pattern, and we have a net long-term capital gain. As we net the two, the $12,700 gain, and we net it with the $7,000 long-term loss. So we have a net long-term gain of $5,000. So our net capital position is a $2,000 loss plus a positive $5,000. So our net capital position is $3,000. So because of the adjusted gross income for the year and the filing status of $42,445, Chevrill's $3,000 long-term capital gain will be taxed at 0% because of the adjusted gross income and the filing status. So as it relates to net capital losses, so the computation of an individual taxpayer's net capital loss is accomplished in the same manner, similar to the computation of net capital gain. And a net capital loss is incurred when the total capital losses for the period exceeds the capital gains for the period. So net capital losses, short-term and long-term, they may be deducted against ordinary income in the amount of up to $3,000 per year. So an important thing to keep in mind is that when we're dealing with capital losses, there's a maximum of $3,000 per year, and that is in comparison to an ordinary loss. So let's say a client has a $9,000 ordinary loss. In the tax year, they will be able to deduct the full $9,000. However, if it is a capital loss, it will take, assuming there are no other transactions, it will take 3 years to write off that loss. 3,000 in year 1, 3,000 in year 2, and 3,000 in year 3. So that's the distinction between ordinary losses and capital losses. And as it states here, there's an indefinite carry forward period. The nature of the capital loss, short-term or long-term, it must be maintained when carrying it forward. And if a taxpayer has both net long-term losses and net short-term losses in the same year, the net short-term losses must be deducted first. And if there's a personal capital loss, unfortunately, they are not allowed for tax purposes. So for instance, let's say someone sells their personal vehicle at a loss. Unfortunately, it's not a tax-deductible capital loss for individual taxpayers. However, if you sell the home at a gain, it is considered taxable. So the ordering rules for capital losses are as follows. So whenever a taxpayer ends up with net capital losses, the losses offset capital gains using the following ordering rules. So net short-term capital losses first reduce 28% gains, then 25% gains, then regular long-term capital gains. Net long-term capital losses first reduce 28% gains, then 25% gains, then any short-term capital gains. Next, we move on to the sale of personal residence. So as it relates to the sale of personal residence, obviously this is, the home that someone has lived in. There are rules that benefit those that have lived in a home for the past 2 out of 5 years. So for gains on the sale of a personal residence after May 6, 1997, a seller who has owned and used a home as a principal residence for at least 2 of the last 5 years before the sale, they can exclude from income up to $250,000 of gain. And if it's a married filing joint couple, up to $500,000, $500,000. So in general, this personal residence exclusion, it can only be used once every 2 years. A personal residence, this can include a single family home, mobile homes, houseboats, condominiums, cooperative apartments, duplexes, row houses. So a seller otherwise is qualified to exclude the gain of the principal residence. Let's say they fail to satisfy the 2-year ownership and they did not live in a home for the past 2 out of 5 years, then in such case, they'll basically prorate the exclusion amount if the residence is due to, employment-related move, health, unforeseen circumstances, or something of that nature. So something unforeseen, that would be like death, a divorce, separation, change in employment, or something of that nature. So something important to keep in mind. Beginning in 2009, because obviously there are some loopholes to this, because as mentioned, the exclusion can be used only once every 2 years. So beginning in 2009, Congress, they closed the loophole in the residence gain exclusion law. So prior to 2009, Taxpayers with multiple rental properties, they can move into a previously rented property every 2 years, reside in the property for the required 2-year period, then sell the property using the exclusion. So, beginning in 2009, taxpayers that rent their residence prior to the 2 years of personal use, they're generally limited to an exclusion smaller than the full $250,000 or $500,000 amounts. So they can't, unfortunately, take the full amount. Sales before May 7th, 1997. So the tax law described below, this no longer applies, obviously, but just to give you some context of how it was, because again, the new law is in place. But before, for sales of a personal residence before May 7th, 1997, taxpayers did not have to recognize a gain on a sale if they roll the gain into a new house with a cost as high as the adjusted sales price of the old residence. So this is kind of like similar to a like-kind exchange. So therefore, many taxpayers who sold one or more principal residences over a period of years under the old law, they have a principal residence basis that's far lower than the cost of the residence. Because the current law doesn't require a rollover treatment, taxpayers get a fresh basis equal to the purchase price of the newly purchased residence. Next, we move on to rental income and expenses. So the net income from rental property, it's taxable income to the taxpayer. And in most cases, rental income is reported on Schedule E. If services are provided to the tenant beyond those that are normally required, then in such case, such as cleaning, maid services, then in such case is reported on Schedule C and subjected to self-employment taxes. So something to keep in mind. Vacation homes. The deduction of expenses associated with a vacation home is limited based on a period of the residence if it's used for personal versus rental purposes. On the whole, it is factored into how many days of the year it was used for personal purposes versus rental purposes. So here we see there are 3 categories of vacation homes in which the tax treatment differs for each category. So first we have primarily personal use. This is essentially if a residence is rented for fewer than 15 days during a year, the rental period is basically disregarded. It's treated as a personal residence for tax purposes. So in such case, the rental income is not taxable, and the mortgage interest and real estate taxes, they are allowed as itemized deductions on Schedule A. And any other expenses such as utilities, maintenance, those are considered non-deductible personal expenses. So that's if it's primarily personal use. And again, it's rented for less than 15 days during the year. Next, we have primarily rental use. So if the residence is rented for 15 days or more, and it's used for personal purposes for not more than 14 days, or 10% of the days rented, whichever is greater, then in such case, the residence is treated as rental property. In such case, the expenses, they have to be allocated. How much is personal usage? How much is rental usage? So if this is the case, then the rental expenses, they may exceed the rental income, and thus it might be a loss, which may be deducted against other income, but subjected to passive loss rules. Something to keep in mind. So again, we need to determine the personal use percentage, and this is the personal days divided by the total days used. And the rental percentage is the rental days divided by the total days used. And for the rental deductions, it's the expenses multiplied by the rental percentage. And next we have rental/personal use. So this is a mix of the two. So if the residence is rented for 15 days or more, and it's also used for personal purposes for more than 14 days, or 10% of the days rented, whichever is greater, the allocable rental expenses are allowed only to the extent of rental income. And in such case, the allocable rental expenses, they're deducted in 3 separate steps. First, the interest and taxes are deducted. Second, Utilities and maintenance expenses are deducted. And then third, depreciation expenses deducted. So for utilities, maintenance, depreciation expenses deductible, there must be positive income following the deduction of items in the previous steps we mentioned. So in addition, the expenses other than interest, other than taxes, they're only deductible to the extent that there's positive income. And much like when it is primarily rental use, the expenses are allocated between the rental days and the personal days before any of these limits are required. And the IRS requires that the allocation be on the basis of the total days of rental use or personal use divided by the total days of use, as we saw in the previous slide. So here we have this example. It says the M. Bale family owns a ski condo in Alta, Utah. In the current year, personal use is 25 days and rental use is 50 days. Data pertaining to the rental are as follows. The problem is asking what amounts were reported on Schedule A and Schedule E for the current year. So we start off with rental income of 10,000. There's interest of 3,000, taxes of 1,500, utilities of 2,000, insurance of 1,500, snow removal of 2,500, and depreciation of 12,000. So here, gives us a hint. First, determine what category the condo was in, and then we did allocate the expenses. So is this primarily personal use? Is it primarily rental use? Or is it rental / personal use? And that will ultimately determine. So since the condo is rented for 15 days or more, and the M-Bale family uses it for personal purposes for more than 14 days or 10% of the days rented if greater, then the property is going to be subjected to the vacation home limits. So in such case, we factor in the gross rental income, which the problem stated is 10,000. And from there, we need to determine the interest in taxes, and we go from there because as mentioned, it is in a 3-part step, and we start off with the interest and taxes. So if we go back to the fact pattern, the interest is 3,000, the taxes are 1,500 for a total of 4,500. So it's 4,500 multiplied by the 50 days that it is rented divided by the total 75 days. So here we see 25 days for personal use, 50 days for rental use. So 50 days divided by 75 days. So therefore, we claim interest and taxes of 3,000. We subtract that first, and it gives us a balance of 7,000. Second, we deduct the utilities and maintenance expenses. So if we scroll back, we have utilities of 2,000, insurance of 1,500, snow removal of 2,500 for a total of 6,000. We factor in the same allocation, 50 days for rental purposes divided by the total days, 50 for rental plus 25 days for personal use. We divide it, and our allocation of the utilities and maintenance is 4,000. We subtract that, we get a balance of 3,000, and then from there we subtract the depreciation. So we see depreciation in this case was 12,000, but on this third step, again, we are only allowed to claim the depreciation to the extent of the positive income that remains. So the $3,000 is the maximum amount for depreciation that can be claimed for the year. So here again, we're just going over the fact pattern, the solution, the interest and taxes allocable, 4,500 multiplied by the 25 days, because again, this represents the personal use. So on Schedule A, they can only claim 1,500. And the rental portion of interest and taxes would be deductible as follows. Interest and taxes of 3,000, which factors into 50 days of rental use divided by the total days, which is 75. The same for other expenses, our utilities and maintenance. And the $5,000 non-deductible portion of the depreciation is going to be carried forward to the next year. So this brings us to passive loss limitations, right? This is very important because, clients, taxpayers, they'll say, hey, my rental property only brought in income of $10,000, but I spent $15,000. Unfortunately, the $5,000 loss, whether or not it's going to be deductible, it's dependent. It depends. So unfortunately, there's been a lot of abuse, primarily involving tax shelters and loss deductions from rental real estate. So in such case, Uncle Sam came up with a solution. Congress, they enacted legislation that limits the deduction of certain passive losses from other taxable income. So in essence, a passive activity is a trade or business in which the taxpayer, they don't materially participate, right? And this includes most rental real estate. So it's very important to understand how tax law classifies individual income. It's classified into three categories. The first is active income. This includes wages, self-employment income, salary, because again, if you don't work, you don't get paid. Next, we have portfolio income. This includes dividends, interest, and then we have passive income and losses. And this includes rental real estate, income and loss passed through from a limited partnership or other ventures in which the taxpayer has minimal or no involvement. So when the taxpayer has minimal or no involvement in an activity, generated losses are passive and they are not allowed to be deducted in excess of passive income. Passive losses, they generally can't be used to offset active or portfolio income. Any unused passive losses, luckily, they don't just go away. They're carried forward and deducted in future years against passive income. And any losses that remain when the taxpayer disposes of the entire interest in the passive activity, in such case, it'll be used in full. So when there's a rental property that's specifically designed as passive, even if the taxpayer actively manages property, but there is a benefit if they actively manage the property. So individual taxpayers, they may deduct up to $25,000 of rental loss against other income if they are actively involved in management of the property. So that's something important to keep in mind. But obviously, there's going to be some nuance. So under the passive loss rules, real estate rental activities, again, specifically, they're defined as passive. But if they are actively involved, then again, they can take this $25,000 loss. Few things to keep in mind: the $25,000 loss deduction, it's reduced by 50 cents for each dollar that the taxpayer's modified adjusted gross income exceeds $100,000. So therefore, there's no deduction allowed when the taxpayer's modified adjusted gross income reaches $150,000. There are different rules that apply if the taxpayer is married filing separate. So just keep that in mind. So in the event that the rental real estate, it's a trade, it's a business. So whenever taxpayers are heavily involved in real estate rental activities, they may qualify as having an active business rather than a passive activity. And if so, then the income and losses from the qualified rental activities, they're not subjected to the passive loss limitations. In such case, it's considered ordinary loss. Why? Because this is the nature of the business. So for real estate rental to be considered an active business, the taxpayer must materially participate in the activity. An individual is going to satisfy the requirement if both of the following are met. More than 50% of the individual's personal service during the tax year is performed in real property, trade, or business, and more than 750 hours of service is performed by the individual during a tax year in real property, trade, or business. If both conditions are met, then the taxpayer is allowed to deduct the entire loss as active business, and it's not a passive loss. So again, it'll be treated as an ordinary loss. So here we have this example. It asks, Her modified AGI before the loss is 118,000. What amount of the rental loss can be claimed? How much could be claimed if her loss is 2,800? It states Daphne is single and owns and actively manages a rental duplex that shows a loss of 20,000. So we know that whenever the modified AGI exceeds $100,000, then the $25,000 loss is reduced. So her modified AGI before the loss is 118,000. In such case, we need to determine the excess. 118,000, which represents her modified adjusted gross income, minus the threshold, which is 100,000. There's $18,000 in excess. So in such case, we need to determine by how much is this $25,000 loss reduced. So 25,000, which represents the maximum loss, minus 50% of the $18,000 excess. So the reason why we are multiplying it by 50% is because, again, for every dollar that exceeds $100,000, the loss allowed is reduced by 50 cents. So therefore, 18,000 multiplied by 50% is 9,000. So therefore, this $25,000 loss is reduced by 9,000. So in such case, Daphne is only allowed to deduct 16,000. In the event that the loss was 2,800, she would be able to claim the full $2,800 loss. Next, we move on to what is called net operating losses. So as it relates to our net operating losses, most taxpayers, again, they're required to file an annual tax return, and the taxpayer's income, unfortunately, sometimes it can lead to some inequity rather, again, among taxpayers that have the same taxable income over a number of years. So in order to help alleviate this problem, Congress decided to enact this, and again, it's primarily designed to provide relief for losses from a trade or business in casualty or theft. So generally, only losses from the operation of a business in casualty, theft, and loss can generate a net operating loss. So that's something important to keep in mind. So if an individual has only wages, itemized deductions with the exception of casualty losses and personal exemptions, they can't generate a net operating loss. This, again, specifically relates to trade or business and when there's casualty and theft losses. So the tax law is designed to permit individuals to deduct these business net operating losses, and then from there, it prevents the deduction of non-business net operating losses. So as we consider the net operating losses, the NOL computation for individual taxpayers, it requires the categorization of items of income, deductions, gains, and losses as either business related or non-business related. So the net operating loss is not just the total taxable loss that's shown on page 1 of the Form 1040. So in general, whenever the net operating loss is being calculated, there's some things that need to be considered. There's no personal or dependency exemptions. As we know, with the Tax Cuts and Jobs Act, personal exemptions are not allowed, but we don't know what's going to happen in light of the election. Maybe we're going to revert to the old tax law. Maybe it's going to remain the same. We're not sure yet. But again, no personal or dependency exemption. There's no deduction for an NOL from a different year. Capital losses in excess of capital gains are not allowed. Any non-business capital losses, so those that arise outside of a trade or business or employment, they can only be used against non-business capital gains. If there's any excess capital losses, these cannot increase the net operating loss. Any business capital losses can only be used against business capital gains, and any non-business deductions. So for example, charitable contributions, deductible medical expenses, mortgage interest, they can only be used against non-business income. So again, as we can see with these net operating losses, there's a lot of nuance in determining what the net operating loss is. So here's some rules for the carry forward and the carry back. So rules related to the NOLs fall into 3 categories, and they've changed 3 times in recent years. In each change, the NOLs are treated slightly differently. So the 3 periods are pre-2018 period, the 2018 to 2020 period during COVID-19, because obviously a lot of businesses took a loss because they had to shut down. And 3, post 2020 period. So obviously, since the NOLs from the COVID period are almost certainly either exhausted or being treated as post 2020 NOLs, loss carry forwards, they obviously have a great impact. So in pre-2018 period, NOLs are eligible to be carried back 2 years and for 20 years. So this is the 220 rule as it relates to NOLs. If it was before 2018, carry it back 2 years, carry it forward 20 years. Carry forward or carry backs can offset 100% of income generated. NOLs generated in this period can be used in the same manner. During the COVID-19 period, NOLs from the COVID-19 period are almost certainly, again, they're either exhausted or they're being treated as post-20 NOLs, obviously because they roll over. And then post-2020, NOLs generated in 2021 and after, they can only be carried forward. They cannot be carried backward, and they are limited to 80%. So just keep that in mind. As it relates to overall business limitations, so to reduce the potential for large business losses being claimed in a single year, starting in 2018, the tax law placed an annual limitation on non-corporate business losses for taxpayers. So after adjusting for inflation, the 2023 limits are $578,000 for married filing joint taxpayers and $289,000 for all other taxpayers. And the business loss limitation, it's in place through the end of 2028. So things might change at the end of 2028. Next, we move on to self-employment tax. So the Federal Insurance Contributions Act, FICA, imposes Social Security, old age survivors, and disability insurance, often referred to as OASDI, and Medicare taxes. So whenever an individual works for a job, they are an employee, they pay 6.2% for Social Security purposes and 1.45%. The employer, on the other hand, matches the Social Security and matches the Medicare taxes. But when an individual is self-employed, they are both the employer and the employee. So in such case, self-employment individuals, they pay self-employment taxes instead of FICA. But if we really think about it, it's the same exact thing, right? So since the individuals have no employers rather, because again, as a self-employed individual, you're both the employer and the employee, the entire taxes paid by self-employed individuals. So much like the FICA taxes, whereby the employees and the employers are subject, the self-employment tax also consists of these two parts, which is Social Security and Medicare, as mentioned. And as we know with Social Security, there's a maximum base amount of earnings that's subject to Social Security each year. And in 2023, it was $160,200. So all earnings subject to Medicare portion, because again, there's no cap on Medicare. The Social Security tax rate is 12.4%, which is the total of 6.2% for the employee and 6.2% for the employer. Our Medicare tax rate is 2.9%, which represents 1.45% for employee and 1.45% for employer. And if a self-employed individual also receives wages that are subject to FICA during the tax year, the Social Security wages need to be considered because obviously it has an impact on the maximum Social Security that is going to be subjected to taxes. So our self-employment taxes, they're imposed on net earnings of $400 or more. Net earnings from self-employment include any gross income from a trade or business, less any trade or business deductions. It includes any distributive share of partnership income from a trade or business, and any net income earned as an independent contractor. So in this day and age, generally a 1099 NEC, 1099 non-employee compensation is issued. And once that 1099 NEC is received, that ultimately, denotes how much is received, or gross income for that individual, less obviously any expenses. In arriving at net earnings for purposes of computing self-employment tax, self-employed taxpayers, they are allowed a deduction for adjusted gross income of 1/2 of self-employment tax. Because imagine, you are an employee and you are only responsible for 7.65%. The Social Security of 6.2 plus Medicare of 1.45%. That gives you a total of 7.65%. If, as a self-employed individual, you're required to pay the full 15.3%, you might say, hey, you know what? I don't want to be self-employed if it's going to cost me more in taxes. So therefore, ultimately, as a self-employed individual, it's similar to the extent that you report the full amount of tax. However, you are allowed to claim 1/2 of the self-employment tax as a deduction. So it nets out to the same thing, that you're only responsible for 7.65%. So here we have an example. It says, calculate Zaria's total self-employment tax, round answers to the nearest dollar. Says Zaria is a self-employed accountant in 2023. From her practice, Zaria earns $108,000 and has wages of $7,200 from a part-time job subject to FICA. So step 1 wants us to compute net earnings from self-employment after deduction for self-employment tax. So 108,000 multiplied by 0.9235. And just keep in mind, the calculation of self-employment tax is reported on page 1 of Schedule SE, Part 1, and has to be included with the taxpayer's Form 1040. So in order for us to determine the amount of tax, we computed the net earnings from self-employment after deduction for the self-employment tax. So 100% minus 7.65, again, which consists of 6.2 for Social Security and 1.45 for Medicare tax. So if we subtract the two amounts, that gives us 92.35%. So we multiply the net employment or the self-employment earnings by this 92.35%. So this allows us to calculate the self-employment or the net income that's going to be subjected to tax. So in this case, it's $99,738. And now for step 2, we have to compute the self-employment tax for Social Security and Medicare. And as we see here, it is bifurcated. It's separated. Why? Because there's a maximum wage base for Social Security, but again, Medicare, as we see in the chart, it is unlimited. So the maximum base for 2023 is $160,200, less the FICA wages. And in such case, we factor in, well, what is the maximum self-employment base? The maximum base for 2023 minus the FICA wages gives us the maximum self-employment base. And then from there, we factor in the lesser of net earnings from the self-employment after the deduction for self-employment tax or the maximum base. And from there, we multiply the self-employment tax rate, which is 6.2% for the employee, 6.2% for the employer, which gives us a total of 12.4%. So if we multiply it, that gives us a total Social Security tax of $12,368. And then we do the same thing for Medicare. But the key difference with Medicare is that there's no limit. Doesn't matter if you make $160,200 or $1,600,200. You're still going to be subjected to the 1.45% for Medicare. So our net earnings from self-employment after the deduction for self-employment tax is $99,738. We multiply it by the 2.9%, which is the employee portion of 1.45 Medicare percent plus 1.45 employer Medicare percent for a total of 2.9. So our total Medicare tax is $2,892. So we compute the total self-employment tax as follows: $12,368 plus the $2,892. So this represents the total self-employment tax, but only 1/2 is going to be deductible because 1/2 would be deductible, and therefore the taxpayer, Zaria, would be responsible for paying 7.65% overall. Next, this moves us to our qualified business income deduction. So the qualified business income deduction, QBI, was introduced in 2018. And this is in effect, this again was a big change with the Tax Cuts and Jobs Act. One of the main things is that corporations, they now have a flat 21% tax rate. So previously, before this change, corporations were subjected to a progressive income tax rate, much like individuals, but now there's a flat 21%. Doesn't matter if they make 1,000, 10,000, a million, flat 21% for a corporation. However, not all business structures or corporations, C corporations. So in order to account for the non-corporate shareholders, this is a deduction that allows individuals to claim a 20% deduction. So qualified business income for a tax year is the net amount of qualified items of income, gain, deduction, and loss relating to any qualified trade or business of the taxpayer in the U.S. And QBI excludes the following. It doesn't include short-term gain, short-term capital loss, long-term capital gain, or long-term capital loss. Excludes dividend income, interest income, a commodity transaction income of foreign currency or loss, any item of income, gain, deduction, or loss relating to certain notional principal contracts. And then it also includes any amounts received from an annuity that's not received in connection with the trade or business. So the tax law provides a safe harbor under which income from rental real estate, even if it's treated as passive, that it can qualify as QBI. So the requirements are 250 hours or more spent by the taxpayer with respect to the rental activity. Any contemporaneous records of the time, it needs to obviously be maintained to ensure that if the IRS decides to probe, that there's clear evidence of the time spent. And there's separate books and records for the rental activities that must be maintained. So some key things to keep in mind. And just with respect to the QBI deduction, the term qualified trade or business means any trade or business other than a specified trade or business or the trade or business of performing services as an employee. Unfortunately, again, trade or business is not necessarily defined by the tax law, but the regulations interpret trade or business to be consistent with the phrase used in the Internal Revenue Code, Section 162, and that relates to the deduction of trade or business expenses. So something to keep in mind. The QBI deduction, it cannot exceed 20% of the taxpayer's taxable income. And again, this excludes net long-term capital gains and qualified dividend income. There's also a wage limitation. So the wage limitation is the greater of. For taxpayers that have taxable income above certain thresholds, so $364,200 for those that are married filing joint, and $182,100 for all other taxpayers, there's two additional limitations that apply, and a phase out occurs if the wage limit is the greater of 50% of the allocable shares of W-2 wages with respect to the business, or 25% of the allocable share of W-2 wages with respect to the business, plus 2.5% of the unadjusted basis for all qualified business property. And in order to calculate the phase out, the taxpayers, they have to determine the QBI deduction with and without the wage limitation. And the excess of the QBI deduction with no limitation over the QBI deduction, that's known as the excess amount. And the excess amount is subjected to a pro rata phase out based on the taxpayer's income over the threshold. So the computer program, for the most part, it factors in all of this, so you don't necessarily need to know the calculation or how to do it manually. Well, I guess it does help, because obviously if clients have questions, again, you always want to think about taxation, not just from preparing taxes, but from a tax planning perspective, because obviously, as we saw, there's a wage limit on the QBI deduction. So therefore, if somebody's paying a low amount of wages, then in such case, it would have an impact on how much can be deducted. Next here we have a specified services business limitation. So QBI from a service-related trade or business may also be subjected to a limitation if the income is in excess of the threshold. So a specified service, trade, or business is basically defined as any trade or business that involves the performance of services, and this is in the field of health, law, accounting, performing arts, consulting, athletics, financial services, basically any other trade or business where the principal asset of the trade or business is the reputation or the skill of one or more of its employees. And just keep in mind, specified service businesses, this includes those that are involved in investing, investment managing, trading, or dealing in securities, interests, or commodities. So just to be clear, a taxpayer in a specified service or business, they're not prohibited from claiming a QBI, but they're not eligible for the QBI deduction if the taxable income exceeds the threshold. So just keep in mind. So in such case, there's a phase out in the event that the thresholds are exceeded. So as it relates to reporting the QBI deduction, there's a special form, Form 8955 and Form 8995A to report the QBI deduction. Form 8995, this is used for taxpayers whose taxable income before the QBI deduction doesn't exceed the phase-out thresholds. And in such case that a taxpayer's taxable income, or given the situation, they do phase out, then they need to use Form 8995A to account for the phase out. So this brings us to the end of Chapter 4, which covers additional income in a qualified business income deduction. So now that the lesson has ended, you should have learned how to determine the term capital asset, apply the holding period for long-term and short-term capital gains and losses, calculate the gain or loss on the disposition of an asset, compute the tax on capital gains, describe the treatment of capital losses, apply the exclusion of gain from personal residence sales, apply the tax rules for rental property and vacation homes, explain the treatment of passive income and losses, describe the basic tax treatment of deductions for net operating losses or NOLs, calculate and report the self-employment tax, the FICA taxes, both Social Security and Medicare portions for self-employed taxpayers, which is referred to as self-employment tax. But again, it is equivalent to FICA taxes for employees. And lastly, computing the qualified business income QBI deduction.